You'll often see the yield curve discussed in financial news. So in this video, we're going to look at what the yield curve is, what drives its shape, what happens when it inverts, and how it varies through a business cycle. That way you'll be able to use the yield curve to your advantage through good times and in crises. So let's look at the yield curve in a bit more detail. Now this is what a yield curve looks like, and along the bottom axis you can see the period of lending to the US government. So beneath me is the yield you'd get for lending to the US government over a period of 1 month. So that's the short end of the curve. And over here on the right of the graph, you'll see the yield when you lend to the US government for a 30-year period. That's currently at a yield of about 2%, whereas the 1 month part of the curve had a yield pretty close to zero. So what is yield? Well, yield is to do with bonds, and this is what the cash flows for a bond look like. So perhaps you pay 100 for the bond today. That's why the cash flow above me is minus 100. It's going downwards. And if the coupon of the bond is 1%, then in 1 year's time, you'll receive an income of $1. In 2 years' time, you'll receive another $1. And because this is a 3-year bond, you'll get your money back in 3 years as well as the final coupon. So you can see immediately that the rate of interest here is fixed. And that's a risk to you as an investor because you've locked in a fixed rate of interest for 3 years. And that means that if interest rates go up, suddenly you'll have locked in a low rate and the price of your bond will fall. So price and yield are just two ways to quote the value of a bond. If you know the price, you can work out the yield. And if you know the yield, you can work out the price. It's just two ways of quoting the same thing. And the key thing to understand with bonds is the inverse relationship between the two. If yield goes up, price goes down. And if yield goes down, price goes up. The degree of sensitivity of the price of a bond to the yield changes is fixed by the duration of the fund or the bond. The longer the period for which you've fixed a rate of interest, the greater the duration risk, and the greater the sensitivity to yield fluctuations. Now, the primary reason for buying bonds is not to get rich because they're fixed income instruments. Most of the time they return much less than equity. But if you're in a position where you don't want to take too much risk with your equity, then you want a less volatile investment. And one of the things that bonds offer is capital preservation. Another reason people have them in their portfolio is that it's a hedge for equity. It's also a hedge which the government pays you to hold. Whereas if you buy derivatives like put options, that's a hedge which you have to pay for. And although now it's a bit of a distant memory, another reason to hold government bonds is because they generate a small, safe income. Now, it's easy to get tied up in knots understanding exactly what yield is, and we've got a bond course which explains what that is in detail, but an intuitive understanding which will help you is that it's roughly the return you'll get for holding a bond fund. Now, the yield curve is a dynamic living thing. It's always changing day to day, and that's driven by market forces like any other instrument. What you can see in this graph is how the yield of 1 year to 30-year treasuries varies over time. So the short end of the curve on this graph is the dark coloured line, and the 30-year bond is the lightest colour line. And what's really remarkable is what's happened to yield since 1960. Now, what you can see between 1960 and 1980 is a gradual increase in the yields across the entire yield curve. Then after yields peaked in the early 1980s, you can see this gradual decrease to the present day. So what are the drivers of the different parts of the yield curve? Let's start off with the long end of the curve, and that would be for treasuries with maturities of more than about 20 years. So this shows you that period from 1980 to the present day, and it shows the 30-year US Treasury yield in red. Now, it turns out that that tracks nominal GDP growth in the US pretty closely. That's the cyan colour here, which I've smoothed over a 5-year period. This is actually the 5-year rolling median, and that's shown in dark blue. Now, it doesn't match the 30-year yield perfectly, but you can see that it does track it fairly well. Why is that? Well, if you're going to lend to somebody, you're only going to lend them at a rate which is sustainable. And because the US government's income is growing at the rate of GDP, that's why we measure GDP, then a sustainable rate of interest would be roughly equal to the income growth rate of the US government. Now, because of that relationship between yield and GDP, we can look at 30-year yield and see what it tells us about growth expectations. And because yields are so low at the moment, that suggests a fairly pessimistic outlook for US GDP. So the 30-year yield at the moment would suggest GDP should be around 3.5%. Remember, that's nominal growth, so if we subtract inflation, that would be a very low level of GDP. The actual trailing 5-year GDP at the moment, if we look at the median, is 4.1%. So the bond market is saying GDP will probably be weak. But we can also turn it the other way around and ask, what does GDP currently tell us about where yields should be? And because GDP growth was okay over the last 5 years, that suggests that yields should be higher than they are today. As I make this video, 30-year yields are at around 2%, but GDP tells us they should be roughly double that. At the short end of the curve, where the maturities are less than 3 years, the drivers are very different. This shows US Treasury 1-year yield versus the federal funds effective rate. Now that's the policy rate which is set by the Federal Reserve, the US central bank. And you can see the two track one another very closely indeed. So really the short end of the curve is set by monetary policy. I get lots of questions about bond funds from our Patreon community, and if you join us, you can actually vote on which questions I answer, and the video answers are only available to members. Another one of the goodies you get is that you can ask questions on Slack from me or any other members of the community. So if you are interested in learning more about that, just click on the link beside me or in the description below me. But the cycle of recession and growth that we see in a country is ultimately the driver of the yield curve's shape, and we usually call that a business cycle. What I've shown here is the 1-year yield and the 30-year yield, so that's at the very short end of the curve and the very long end of the curve, with the 1-year rate in black and the 30-year rate in blue. And the shaded blue rectangle beside me shows a period of US recession. And that was the recession that followed the dot-com bubble in 2001. Now remember the two different drivers for the different parts of the yield curve. The blue line reflects growth expectations, but also inflation expectations because it's nominal growth for the US economy, and that was gradually decreasing through this period. Then the black line, which is the short end of the curve, closely tracks the Federal Reserve's policy rate. And when the Federal Reserve sees a recession coming, generally it cuts interest rates very sharply. And that's exactly what happened through this recession. So what that means in practice is that when times were good before the dot-com bubble burst, the yield on 1-year and 30-year treasuries was roughly equal. That meant that the curve was flat. Then when recession hit, the Federal Reserve reduced the short end of the curve. That meant that the curve went from flat to upward sloping. That's called a steepening of the curve. Then as the economy started to recover, the Federal Reserve raised interest rates. So that's why the black line here is moving upwards. So the overall shape of the yield curve was flatter, but it was at a lower rate than it started. And that was because of lower growth expectations. If we look at the global financial crisis, the situation is similar. We start off at high and flat levels of interest rates. So the 1-year part of the curve and the 30-year part of the curve are both at roughly 5% interest rates. Then when the crisis hit in 2008, the Federal Reserve cut interest rates sharply. Although the long end of the curve did take a dip as people were scared, it fairly quickly snapped back to the yield it was at before. During the period between 2009 and 2015, you can see that the yield curve was pretty steep in the US. Then as the Federal Reserve raised interest rates from 2016 onwards, the curve started to flatten again. So this pattern through a business cycle of flat to steep to flat is one that plays itself out repeatedly. But gradually the rates to which the yield curve returns when times return to normal have been lower over the period since 1980. And that's largely because growth and inflation expectations are lower than they were in the past. So now that we understand a bit more about the yield curve, how can you use that to your advantage by buying and selling bond ETFs? So let's go back to the financial crisis. This is the period between 2006 and 2019. And this top panel shows you the 1-year and 30-year yield, which we saw previously. The bottom panel shows you the return of 3 bond funds. Now these are all iShares US Treasury funds, but the big difference between them is the duration of the fund. The black line shows you SHY. So that's very short duration US Treasuries. In fact, the duration is so low that they're very similar to cash. You can see that the price of the fund hardly varies. The volatility is very low. The blue line is an intermediate duration fund called IEF. That has 7 to 10 year US Treasuries in it, and you can immediately see that it's more volatile. The price moves around a lot as the yield curves move. And then the red line you can see here, which is very volatile indeed, is for the longest duration US Treasury fund, and that's TLT. That fund is exquisitely sensitive to shifts in the yield curve. When yields rise, its price falls sharply, and when yields fall, its price gains sharply. Now you can see beneath me what happened to those three funds as things really kicked off during the financial crisis. SHY, the black line, does shift up slightly, so it did offer capital preservation and a small gain. But the fund which gained the most was TLT, and that's a pattern which we see repeatedly when equities sell off sharply, which is that the longest duration bond funds gain the most. So the trade-off here is that if you are trying to hedge an equity market crash, you'd go for the longer duration funds. The drawback is that they're very volatile, so you may well see the price of your bond fund fall sharply for some periods of time. So for example, in the last quarter of 2016, you can see that yields rose very sharply, and as a result, you can see TLT crashed quite severely, whereas SHY hardly reacted at all. If we look at the short-lived crash in equity prices during 2020, the pattern is quite similar. The Federal Reserve cut interest rates sharply, and as a result, TLT gained hugely in value, although there was a bit of a wobble. IEF, which has kind of intermediate duration because that's 7 to 10 year bonds, rallied less, and SHY rallied least. In the recovery period after the crisis, you can see yields were rising and the value of TLT fell sharply. Now some people claim that because yields were so low that bonds no longer offered a hedge for equity. As you can see, that's simply not true. Now people sometimes talk about yield curve inversion. What I've done here is to take 3 snapshots of the US yield curve at 3 points in time. Now most of the time the yield curve will look like the red line, where the short end of the curve has low rates and the long end of the curve has high rates. That's because investors usually demand a higher yield for taking duration risk. So lending to the government for 30 years generates a higher income than lending for 1 month, say. And you can see the yield curve was steepest in 2011. That's a period when growth and inflation expectations were still fairly high, so the long end of the curve was still high, and the Federal Reserve had pushed the short end of the curve close to its zero bound. So that's why the curve was very steep. The curve was the flattest it's ever been in 1978, but sometimes the yield curve does something weird. So instead of looking like this, it inverts to look like this, where short-term interest rates are greater than long-term interest rates. And that's often a sign that the US economy is about to hit the buffers. Now the Federal Reserve Bank of Cleveland publishes this model, which you can see on their website, which works out the probability of recession based on the shape of the yield curve. Now it's certainly not a perfect indicator. So for example, you can see that there was a false alarm in the late 1960s and a few more false alarms in the late 1990s and around 2000. And some people joke that it actually predicted the pandemic in 2020. But remember what makes the curve steepen. Usually what happens is we've had a crisis, the economy's recovered, the Federal Reserve is raising interest rates, and if the Fed's short-term interest rates move above expectations for growth and inflation, that's usually a bad sign. Or you could see it as a self-fulfilling prophecy because the Fed actually creates the recession. The Federal Reserve wouldn't want to do that, but it may be that they raise interest rates too sharply and that does trigger economic problems. So I hope that's helped you understand the yield curve a bit better, but also how bond funds react to equity market crashes. I think they do offer a way of protecting against capital losses, and potentially if you go for long duration, they can give you quite a good equity hedge, but that comes with higher volatility. But most of the time, remember, equity will outperform bonds. So if you can stomach a higher equity allocation, that'll be better for your portfolio. Now remember, you can support us on Patreon. We had the links earlier. There'll be one beside me and in the description below me. And as always, thank you for listening.